What is up, guys? I hope that you all are doing well. Welcome to the first episode of the 2025 Public Mentorship. During this mentorship series, I will share with you everything you need to know in order to understand the algorithmic price. During this mentorship series, I will share with you every single week around 1 to 2 lectures. These lectures will consist of either market reviews, education content, or trade breakdowns. So this lecture series is going to be the first series which I will ever release for my YouTube channel, and therefore I am really excited to share it with you guys. I look forward to hear your response to this mentorship because I will provide you the highest possible education content which is out there in the trading space. All I'll ask you is to submit the time, meaning show up every single week, put in the work, and investigate what I'll ask you to investigate. And I want you to work towards. As well as whatever I'm gonna teach you guys is I have learned from ICT, aka Michael Huddleston, and his student Zusi. And for without being said, let's just go ahead and begin with this first lecture. So, this is just going to be the foundation to understand my internal dialogue of interpreting the price action. Okay, I'm going to cover with you the basic. This means that I'm going to cover with you the smart money paradigm, liquidity, efficiency, where to buy and where to sell, market maker models, and some other insights based on them. This lecture is going to be rather basic, but it's still very important that you take proper notes because this is the information that we will be building upon this mentorship. So this is how I internalize the price action, and I hope that at the end of this mentorship, you will be able to do the same if you put in the required work. So let's just go ahead and start. Firstly, the topic which we are going to discuss is smart money paradigm. Okay. I'm going to discuss the smart money paradigm with which I go at the price action in the markets in general. The smart money paradigm basically consists of one main belief, and that the following: I am in the opinion that all the financial markets are absolutely rigged and controlled. These markets are rigged and controlled by certain entities. These entities used to set price manually. So that means that they use to determine the price of the assets manually. But so it was like previously it was done by humans. But when everything switched to technology, artificial intelligence, they automated this process and they created algorithms. This algorithms runs based on time and price. Guys, attention. These algorithms run on base based on time and price, a hidden gem for you. That means at the certain times of the day or the certain times of the week, of the month or of the year, there are going they are going to cause specific price runs within the market. And I must admit, however, that supply and demands holds a certain influence over certain markets. The markets that are influenced by supply and demands are real world assets. This means, for example, that the oil market, the wheat market, the grain market, this all are influenced by supply and demands. However, even in this markets, this shows the algorithmic signature that we are going to learn. So the algorithmic signatures that we see within this derivative markets or the future markets which I trade. Okay. So Think about futures market this ways. The futures market are basically created out of thin air, which means nothing. Then ask a following question. If they are created out of thin air, meaning, listen carefully, guys. Futures aren't like stocks or commodities that you can hold in your hands. They are literally agreements created out of thin air, printed on an exchange. Now, the real question occurs is, if they are created from nothing, who decides their value? Hmm? The answer is not the retail traders. It's the exchanges, the market makers, and most important, the smart money who pours liquidity into these contracts. That's why understanding who controls the flow is the foundation of trading futures markets. Okay, now enough about the smart money paradigm. Let's dive straight into the beginning of looking this algorithmic price signatures within the delivery of price and how we operate in dealing ranges, which is in front of you. So here we are looking at the simple schematics of a dealing range. Here you can see a dealing range with the price of 0 to 100. The reason why I'm sharing this with you, the simple schematic, is because the schematics is the foundation of how we how we internalize the price action. We want to always buy in deep discount, okay, relative to the current dealing range. So this is the dealing range from 0 to 100. We wanted to sell short or we wanted to sell in deep premium. The reason why we wanted to do this is because of the following. Think about if you're going to a mall, a supermarket, a grocery shop, and let's say that you're looking to buy cheese which is made up of milk. Okay. So, would you rather pay $3 for cheese or would you rather pay $5 for the cheese? Of course, you would always pick the former. You would try to buy it for $3, right? Because it's cheaper than $5. But let's say that now you're the owner of the store and the store owner wants to make as much as revenue as possible. So your goal is to make profits. Would you rather sell the cheese for $3 or do you want to sell the cheese for $5? The answer is of course obvious. You would much rather sell for $5 because the amount of revenue that you get from this one product of cheese is higher. Hmm? Of course, there are some other reasons that pricing is based upon, but for this rather simple example, I'm just sharing with you where you wanted to buy and where you wanted to sell. But when we look at the financial markets, we are looking at the exact same paradigm because we wanted to buy in deep discount, and a deep discount occurs when markets are going down. Why do we wanted to buy when a market is going down? Because when the market is going down, that brings with us, that brings with it fear. And we wanted to be hopeful when others are fearful. Okay. So that means when the masses or other retail traders are fearful, we wanted to be excited, really excited, because we will look for the opportunities to long or buy that. That is how the algorithm is created, guys. That is how the smart money operates. They create a certain narrative to then do the opposite. They create fear so that they can fill their position and reprice higher than the opposite. You can, like, they create hope when the when in reality you should be fearful. Okay, like this is for the opposite, guys. Okay, when you're going to short or sell short, because the smart money is utilizing that run higher to sell short against in a deep premium, and that's how the reality is. You should be fearful because smart money is utilizing that run higher to sell short against in a deep premium, and that's how this market moves from premium to discount, discount to premium. So now let's continue to the next theory that is required for our foundation. Okay. So here you can see the exact same dealing range, but without all the color stuff inside of it. Here you can see that there is a line on the lower of the dealing range, which is an old low. Below this old low, sell side liquidity rests. You might be wondering, what is liquidity? Liquidity is basically engineered stop losses of the retail minded traders that places their stop loss below an old low. The market will try to gravitate towards this old low and reject of them if the higher time frame or the order flow is bullish. So that means if the market is predetermined to grow higher, then every run on an old low, on a crucial old low to say, is considered as a turtle soup. We will discuss this later on, of course, more, but I just wanted to focus on this now. Now, above old high, okay, now above old high, we see buy side liquidity. Buy side liquidity is our engineered stop losses of shorts, and sell side liquidity are engineered stop losses of long. Retail minded traders long above old lows and they short above old highs. The dealing range below sell side liquidity, okay, smart money buys here. Smart money buys, and above buy side liquidity, smart money sells. If you think back to the first concept that I have shared with you guys about where we wanted to buy relative to the current dealing range, you might be wondering, how can we buy outside of a dealing range? Or how can we sell outside of a dealing range? If we see price trade below an dealing range, so in this case, below an old low, okay, so below an old low, the market is now trading inside of an external range liquidity. We will discuss this later on more because this requires a lot of chart works to transfer the knowledge to you. But just understand that outside of this dealing range, so below this black line, price is in a very deep discount relative to this dealing range. Okay, above this buy side liquidity, higher prices is also in a very deep premium relative to that dealing range. So what is price likely to do after trading outside of this ranges, either on the upper end of the lower, like either on the upper end or on the lower end? It's likely to retrace back into the range. This is something we will discuss later on in the mentorship more often, because this is crucial to understand how the market moves. Okay, so now I'll come to that page, guys. I'll come to that page. That is a topic. So here we are going to discuss the second part of this lecture. So during the first part, we have discussed ranges and liquidity, and now we are going to focus on inefficiencies. An inefficiency or an imbalance in the price comes as a result of algorithm that the price reprices too quickly. The term repricing is a term that I will use more often within this mentorship, so it's important that you understand that it's like what means repricing. Okay, note this down, please. Basically, like repricing basically means that the price is moving, or price is being moved from one price to another. Okay, so yes, now I'll also come to that page, guys. I can understand how excited you are. So this is like now the page which I'm showing you. Like if the algorithm that delivers price, okay, the price reprices too quickly, gaps are result of that price, and price will seek to reprice into this gap. Okay, here, as I said, premium to discount, and price will seek to reprice into this gap to offer smart money the opportunity to enter their buy or short at a fair value relative to the current dealing range. Therefore fair value gaps exist. Okay, so now here I'm going to take you with me to look at the two most common gaps, or the fair value gaps out there. So the first fair value gap that we are going to look at is a bullish fair value gap here. Okay, here I want you to focus on this page. So bullish fair value gaps, this is also called a BC, a buy side imbalance, a sell side inefficiency. This means that the imbalance is on the buy side and the sell side was inefficiently delivered. So that means at a later point in time, price will come back to this price range to rebalance this inefficiency. And here is the bearish fair value gap. This is also called a CB. Okay, here. So this is also called a CB. This is a sell side imbalance, buy side inefficiency. This means that the imbalance was on the sell side and the inefficiency was on the buy side. So it means that the buy side has to be offered at a later point in time within this price range to balance this sell side imbalance, buy side inefficiency. Okay, so inefficiencies are the result of the algorithm repricing too quickly. Therefore these gaps will be revisited at a later point in time to rebalance those price range. Before continuing with the move that was in the direction of the imbalance. So that means that if we are bearish and we are expecting our price and we see the creation of a CB, we anticipate price retracing back into this CB before it continues to fall lower. Take note guys. So now you can conclude that what makes price move. I want you guys to take notes of this. I'm reminding you back again. What makes price move, or to what price draws, to precise, like to be precise, price either draw to liquidity in the form of buy side liquidity or sell side liquidity, or it looks to reprice into an old imbalance to rebalance that imbalance. Okay, so now let's continue to the part 3, wherein we are going to combine this theory. So let us now look at the first market maker model. Exciting, guys. So the market maker models are the models through which I internalize price actions. These models are used to put structure in play for my internal dialogue when it comes to looking at the price action. When we are looking at the first model that we are going to discuss, we can see like this is a market maker buy model. Okay, this is a market maker buy model. A market maker buy model is a bullish model. This model occurs in the bullish markets, mainly in the cleanest form, but it also occurs in bearish market. Later on, we will learn why and how. First of all, we are going to do some pattern recognition for the market maker buy model. It is crucial to understand that there is an original consolidation somewhere. This is where the market was being held inside of a range where buy side liquidity got engineered. Retail minded traders will look at this consolidation up there and think to themselves, this is a strong resistance. The market then begins to fall. Okay, it retraces, continues to fall, it retraces, continues to fall, it retraces and continues to fall. This delivery of the lower price on the left hand side of the curve is what we call the sell side of the curve. So the sell side delivery is in play. This means that the down close candles are delivered on the left hand side of the curve. Okay, here. So this is occurring because the price is drawn towards a key level. For this lecture, we are going to say that this key level is a higher time frame BC, a buy side imbalance, sell side inefficiency, a bullish fair value gap. The market reaches this level and then we see a turtle soup form, and then we deep like once this turtle soup is formed and then we see displacement to the upside. You might be wondering, displacement? What is that? Right? Displacement is basically the move that changes the delivery. So that means we are delivering lower on the left side of the curve. We displace above a certain high. Which high, you might be wondering, right? I'm talking about this one. Okay. And from there on, we believe that buy side is now going to deliver. So that means up close candles are likely to come. The change in state of delivery is a term that is hard to understand. Okay. The theory behind it is hard and as well as, but to begin, we are going to focus solely on this high getting broken. Okay, right here, when this high gets broken, we believe that the market is now going to deliver higher. And the algorithm has shown its hand to us that now we know the higher prices are next. When we take look at a schematics, I want you to imagine the following. I want you to take a look at this lake right here. Here. What does that consist? Think about this, guys. Okay? What does that consist? A CB. A CB is inside of this lake. The market will retrace into the CB that created a high, then distributed to the downside, deliver lower. We see that the smart money reversal here. This is where the smart money buys below a key level, then distributes, sorry, like where the smart money buys at that key level inside of the higher time frame BC at a higher time frame fair value gap, as we discussed, below an old low in a deep discount. Then we see displacement to the upside, change in state of delivery. Okay, what will be the market now do? It will retrace into an imbalance that has formed inside of this displacement leg, into this high right here. One thing I want you to focus on studying the market maker buy models, but also the market maker sell model, is this change in state of delivery. Because what you will often see is like there is a CB, okay, inside of this leg, a high get forms, okay, this gets formed and here, okay, this is what I label as an intermediate term high. And when I see that the market displays above this intermediate term high, that is a change in state of delivery for me. So the next retracement into this busy inside of this leg, okay, a high like here. Now the next retracement into this busy, as I said, is probably a price range from this high to this low. So here is a buy for me. We then see continuation, okay, high, like continuation high. Market engineers more buy side liquidity below the original consolidation. The smart money retraces, buys more, and continues the higher prices into the key level. Okay, now what is inception? The inception of the market maker buy model. With inception, I mean that the moment that higher prices are getting delivered. So that means the moment that the smart money reversals take place. Okay. The terminus takes place when price crosses the high of the original consolidation, how price trades above this high or above this engineered high determine what will follow next. Okay, now here here we are at the market maker sell model. For the market maker sell model, I want you to completely inverse what I just described to you with the market maker buy model. But here's a quick breakdown. We see that the market is consolidating in here, okay, and then begins to expand to the upside, retraces, it expands, it retraces, it expands, it retraces, it expands until this key level reaches, okay, like it reaches this key level. This key level is the low of a daily CB, remember guys, okay. So the key level is the low of a daily CB. Market trades into this. We see a turtle soup form. Market displays to the downside, retraces into what? This low right here, which is an intermediate term low. And this is really important because it forms, like it has formed inside of a BC here, inside of a price range, and it was the last low that formed before the expansion into our key level. Then we see the displacement below this. This is our change in state of delivery, or our market structure shift of, or our break in market structure, whatever you want to call. It's all the signal that we are now from a buy side delivery, okay, from here a buy side delivery to switching to sell side delivery. The market begins to fall, it retraces, offers buy side into what, a CB that has formed inside the price range, expands lower, retraces, and eventually hits the terminus. The pattern of a BC intermediate term low CB is something what I will touch on more often in future, and more lecture will be made around this topic, because detecting the change in state of delivery is far one of the most crucial skill to learn. So we are coming to the end of this lecture, okay. Within this first education lecture, you got introduced to the foundation of learning how I view the markets. This has been taught by aka ICT. I will recommend you guys to go ahead and check his channel, okay, wherein on his public mentorship he has taught this. But I want you to now focus really on market maker models. This will be really helpful for you guys. So for the newcomers, you might feel that this was a very advanced knowledge, and that's logical, guys. But over time, when you get more experience, you will look back to this first lecture and you will realize how simple it was truly. Okay. There are levels to be achieved. There are levels to the markets, and the levels that are present every single day and every single week that that defines where you are at. That is the result of the amount of effort that you're going to put into this learning. So watching my lectures or ICT's lecture or seeing his reviews, my reviews are not gonna be enough. You will have to put in work yourself. Okay. You will have to go out there, you'll have to study, and you'll have to work in an organized manner for the remainder of the August. I'm going to share with you the lectures. Okay. I will bring up concepts that were not discussed during this first lecture. So if you feel like the lecture were too much in terms of what is that, do not worry, guys, because this lecture is just going to be a showcase of what is possible, firstly of all, and secondly, what you're going to get towards hopefully in the upcoming periods. So, thank you for watching this lecture till the end. And this is the first lecture of me. So, best of luck, guys. And I wish you have a nice day. Be safe. Take care of yourself, your family, and your loved ones. And enjoy the rest of your life, day, week. Stay grinding, guys. Stay grinding.